And as we've heard earlier in the program, the unemployment rate has fallen to a 48-year low, dropping from 3.5 to 3.4% in July. For analysis, let's bring in Warren Hogan, economic advisor to Judo Bank. Warren, what do you make of this number today? You've got the unemployment rate down to 3.4, employment, though, down 41,000 jobs. What do you make of the numbers?
Yeah, thanks for having me on the show, Kieran. I think the unemployment rate's the focus here, and it highlights just how strong not only is the economy, but how much demand for staff there are across all organisations in Australia. Really, the 40,000 odd fall in employment probably just is a bit of payback after the strength we've had so far this year, so I wouldn't read too much into it. Participation was also off a little bit, but really the key number is that further decline in unemployment, and really highlighting how tight the labour market is, given that most estimates of full employment are around 4%. So we're continuing to move not only through it, but well through it.
And what are these numbers telling us above, in terms of wages, where growth is heading, given yesterday's numbers as well, today's unemployment rate? How do you see the wages story unfolding?
Yeah, well, I think there's a lot more information in these figures about where wages are going than what we saw from the wage price index yesterday. And that is because we have got this very tight labour market, and these numbers are telling us that wages are really set to accelerate. The key number for me that's been a very accurate predictor of wage trends is the underemployment rate. So it's a broader measure than unemployment. It includes hours worked, and people who want more hours, which people are getting sucked into doing more hours because of the strength of demand for labour in the economy. And these numbers today tell us that wages growth should be comfortably above 4% by early next year. And we can cross-check that with things like business surveys, which are pretty much telling us the same story in the last few months. So yesterday's wage numbers still low, but we are really set for that to start to heat up over the next 6 to 9 months.
That is good news. But what's the overall story then for interest rates? How do you read the RBA's next move, given what we're seeing there?
Well, for the RBA, they have still got a fair bit of work to do to get the cash rate up to what is regarded as a neutral setting. That is a setting that doesn't help or hinder the economy, which I think most people are thinking is around 2.5% to 3%. So they've still got more rate hikes to do. They might as well just get them done as they keep rolling through the meetings. And I think some of these wage indicators that are telling us wages will continue to accelerate will give them confidence to get there quickly. So I think the market's expecting a 50 basis point move. Maybe it's 40. Maybe they'll just go up to 2.25% and get back on those 25 increments. But I think we can expect to see rate hikes right through to the end of the year. The risk for interest rates is really what happens next year beyond a cash rate of 3%, and that's where the wages story comes in, and that's where these labour market figures come in. If we see that unemployment rate head towards 3 or below, then that's going to be a real concern, because it suggests rates are going to have to go even higher than 3% in 2023.
The UK inflation has surprised again, now up 10.1%. Are there any concerns you have in relation to that happening in Australia? Are there any similarities?
Well, it does show you what is happening elsewhere, and we are lagging events overseas when it comes to inflation. But the UK and Europe more generally has these particular problems related to energy, gas, electricity prices. 10.1% is the highest rate of inflation there since the early 1980s. It was higher than expected, but the Bank of England just recently forecast it will get up to 13%. And you can see why when you look at the detail. Utilities and housing costs have increased by 20% in the last year in the UK, which is a massive cost of living squeeze. And the other big mover, which of course is a problem, is food and non-alcoholic beverages, up 12%. So these are two essentials of life which are really moving, and you can understand why there's so much pressure in that community over there when it comes to cost of living and finances.
And finally, what's your view of this safeguard mechanism review? It's a very complex area of policy, obviously, dealing with 215 of the heaviest emitters, part of the government's emission reduction plan. But what's your take on what you've seen so far from the government on that?
Well, it's early days and it's now open for discussion. And I think the commitment to continuing the safeguard mechanism in some form is important. I think it needs to be transparent, the process, not just the review process, but obviously the safeguard mechanism itself. And we've got to get a right sense of balance here. We can't have corporate welfare, but at the same time, we can't be driving industries into the ground that have a long-term future. I think the key missing piece in the discussion so far is the broader industry policy and industry ambitions from the government. They haven't really articulated that since the previous government's modern manufacturing strategy. So I think my key issue is making sure that whatever they do with this safeguard mechanism and their broader emissions targets and environmental policies, that it's heavily linked into what they're doing with their industry policy, which I'm sure it will be. But of course, we can't always assume that governments make sure all their departments are talking to each other.
Good call. Warren Hogan, great to see you as always. Thanks.